Hey traders, today we are continuing down the path of technical analysis, and we are going to talk about market environments. Market environments are important, especially if you're using, trading methods that are specific to certain market environments. They're way more accurate under certain conditions. That's why a lot of times, a lot of these EA, expert advisor systems, software, they'll be great for a while. Say you're trading a pair and it works great, you're getting consistent profits on, say, the euro US dollar, but all of a sudden the market environment's changed and the expert advisor can't adjust to it, so it fails and you start losing money. It's the same thing if you're using certain tools of the trade. Make sure you're paying attention in which market environment it is. So to get started, let's talk about the two basic types of market environments. We have a trending market, which has strong directional movement. If you haven't watched my episode on trend lines, I would watch it. It gives a good explanation on directional movement. Basically, just is the market moving strongly in one direction, either up or down, up or down. And if it is, it's considered a trending market. The other kind of market is a trading market or a ranging market. It's one that has a low directional movement. It's probably at the close to the 3 o'clock clock angle, where this is at the 1 to 2 or the 6 to 5, or 4 to 5, excuse me. This is usually around the 3 o'clock clock angle. It's ranging. So those are the two different types. And in a trending market, it kind of is best to use moving averages and Fibonacci levels and trend lines. Trading market, kind of some better tools or pivot points, support and resistance levels, oscillators, and daily highs and lows. The two things to consider to go even deeper into a trending market versus trading market are the one I already mentioned is directional movement, and the second is volatility. Volatility can be expressed mathematically by finding the standard deviation or doing analysis of variance and ANOVA analysis, if you want to get really, really technical about it. When we talk about time, I'll talk about the times a day where there's high volatility and high chances of reversal. That's all done with a program. I don't do it by hand. It's hard to do it like that, but there's an easy kind of visual way of looking at volatility and directional movement. For directional movement, going back to the trend line lesson, we're looking at something, give it a clock angle. A high directional movement's between like 1 to 2, low is between like 2 and 3. Or if it's a downtrend, a high it would be between like 3 and 4, or 3 to 6, 4 to 6, low directional movement between kind of 4 and 3. Now volatility is just simply the variance within the movement. So this has low variance. Look, it's going up and then it kind of comes back and there's a little bit of retracement. The problem with this scenario is, where do you enter? Yes, I want to get on this trend, but most trend following things, like if you made a trend line that went from this low, oops, I thought I grabbed the right thing, but I didn't. Let's see, this low to this low. It's the trend is so high that it's kind of hard to even see where to get in. Look, you're like, oh, you'd buy it. Where would you buy it? It broke the trend line. What do I do? So steep. There's not enough volatility. Whereas this has high volatility and high DM. So look, price is going up, yes, but it's retracing a lot. It's bouncing back and forth a lot. You kind of get this wave rippled formation, but it's still going up high, So you got a steep clock angle if you took the average movement. But within that movement, there's this variance where it's bouncing up and down within that general movement. These are easier because then you can, like you said, get your trend line out. Let's say you're even doing it just right here. Let's say that this move stops right here, and you're looking at it from right there to there. You project it out, it goes back up, and look, boom, bounce off the trend line, and then you have a buy. But it's because you have that certain amount of volatility going on. Now over here, this is more characteristic. These two are, I would consider, trading market or ranging market. These are obviously trending markets. So in this instance, this is when you have a high amount of volatility but a low amount of directional movement. So in this type of situation, again, we're going to look for to use pivot points, SR levels, and oscillators. And we're basically looking to buy the lows and sell the highs. We're not looking for huge trends. We're not going to look for the huge profit levels, because the price isn't moving dominantly in one direction. It's just bouncing all over the place. Still can make money though. All you'd have to do is, talked about this again in the support and resistance level episode, but you'd simply buy the highs, sell the lows. I said that backwards, didn't I? Buy the lows, sell the highs. Buy the lows, sell the highs. Buy the lows, sell the highs. Right now, this looks like if the market was doing this, it means it's respecting the same low over and over and over again. If that was the case, that's kind of a reversal formation, especially because you're not making lower lows, or lower highs, So I would just look to buy right here. Boom, buy, 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 and look for a breakout in the upward direction. The other reason for doing that is you have an entry point. Here, if you're looking for sales, it's there's some variation obviously because there's some slope, but here's a straight level. So you could just look buy, oh look, it's right back there. And so you have like a hammer or tweezers right here. Buy again. And then you have it again and buy again. Where you take your take profit level, I would usually take it at the previous, within probably 5 pips below the previous high. I take about right there. So I just, if I bought right there, take the profit, about right there. I just continue it over wherever that is. And same thing again. If I was a buyer, I'd take profit right there. Now, if you think it's going to, say this does like a triple top, and then this triple top is forming right here at, say, right before the opening of New York session, I would buy and maybe buy 2 lots and look for a breakout at that time. But that's taking time into consideration, and we'll talk about that here in another episode or lesson, whatever you want to call it. Here is this last type we're going to talk about. This has low directional movement and low volatility. This is where price really looks like it's going sideways, really towards that 3 o'clock level. And not only is it doing that, but there's not a lot of bouncing. This is really hard to get into. This is something I stay away from, because when you calculate spreads into your risk-reward ratio, you're risking so much, because price is bouncing so much. Fortunately, when this happens, usually it's just a brief consolidation period. You'll see this low DM, low V when it's you're looking at a continuation in whatever trend it is. Price just isn't sure what to do, or maybe it's 11 o'clock, or rather, sorry, this is my time frame. Let's say, midnight Eastern time, Eastern Standard Time. Price will consolidate before London opens. At the end of sessions, price will consolidate. Or say you're trading in New York. If you look about 12 p.m., unless there's some release from the Fed or something, price will consolidate because people are going to lunch. That's another thing to do with time. So you got to look at this. This is a consolidation, but got to pay attention what time this happens. A lot of times, say a price is going up, and then it goes down a little bit, it'll consolidate, and then as soon as people get back to their lunch, it'll go back in this original direction. But I would stay away from it when it's doing this. It's kind of hard to make profit, unless you really know what you're doing. So until you get a hold of market environments and add that to a time element to it, I would stay away from a low DM, low V. Now to kind of further this, I would go, and you're going to have to do some bathtub analysis. You're going to have to take charts like I was showing you, and go from one candlestick to the next, and kind of figure out your own kind of classification for these things, directional movement and volatility. I'd throw a medium in here. I'd have a high volatility, a medium volatility, and a low volatility. And high directional movement, medium directional movement, low directional movement. But that's kind of your own personal preference. I just wanted to show you the two extremes, and not, the other one is going to be so subjective I'm not even going to go into it because it's going to take too much time and it might confuse you. That being said, let's look at some practical examples. So we look right here. What would you call this? if we took, let's say, let's just take the last little bit of time frame. And this happens, it's like 3 o'clock right now, so 5 o'clock p.m. New York time. So, you know, the market's closed right now, has been, so it's going to be even more consolidated. But we look at the larger time frame, there's even a larger set of consolidation. So right now I'm just going to look for a rectangle. And look at this. This is consolidation from here to here. There's like no directional movement. It's pretty much just sideways. And there's not a whole lot of volatility either. I mean, price is wiggling a little bit, but not a lot. Now if we zoom into this, it's going to look a little more volatile though. So we're still within the triangle, right, or the rectangle I drew. But look, we're on the 15-minute time frame, so you can see the jumps a little better. Now there is a little bit more volatility. This goes into time analysis too, but it depends what type of trader you are. Are you a day trader? Are you a swing trader? Are you a, scalper? What do you do? But that's a conversation for a different lesson now. But what I'm getting at is that on the 1 hour time frame, this looks like low directional movement, low volatility. I'd say maybe medium volatility. You still, look, you have this common area support, look, right here, right here, right here. So, I might look for a buy right here, and then a sell right here, and then look a buy, and then a sell right here again. So that's kind of a low DM, medium volatility. I know I said I'd stay away from it, but now I look at it, it's kind of hard not to, or hard to. So let's keep moving on. Oh yeah. Now look at this. This is kind of a medium directional movement. But look at the volatility. Up and down and up and down and up. And look, who knows what's going to happen now? Is it going to go back up higher? But, again, volatility is not always a bad thing. You could have entered a buy right here and you would have made some money. And who knows, the market still might go up. But this is kind of a medium to low directional movement with a kind of a high amount of volatility. So what are we going to look for? We're going to look for trend lines right in this situation, right? What else are we going to look for? Fibonacci levels. So right here, we're looking for buy at one of these Fibonacci levels, these retracement levels. Now some people say if it breaks the 38%, then it's going to be a reversal. I kind of think it depends on, again, market environments. If you have a high amount of volatility, then you're going to look for a lowered retracement level because price is bouncing so much. Doesn't mean that it's not a good trade. It means that you got to be careful with your entry though, because you're going to have a higher risk reward ratio. But that's not always a negative thing. If you had more things on your side, you're also the higher the risk reward ratio, the higher risk, yes, but also the higher the reward. But that also, to me, means you need to find more than one reason to enter the trade. So right here, you also have this vertical SR level, support right there, resistance right there, support right there, support right there, support right there, support right there. So that's another thing on your side. Now let's say that you went down the time frame and you went to the 5 minute and you saw candlesticks right here. They indicated that it was a reversal. So you had tweezer tops or hammers. And that's what you're looking for. You're looking for overlays. Hammer that down one more time. Overlays are great. Let's delete these. Forgot to turn off the grid. I'm sorry. It's going to look a little funny. I'm trying to keep going over a little further into time than I want to. So I'm trying to keep this a little shorter. So please, I apologize. If you can't, try to keep up the best you can. Now there was one here. Oh, look at this. This is a situation where you have high DM. Look at that. That's like a freaking 4 o'clock clock angle if I've ever seen it. 4 to 5, right? High DM, low volatility. And look, it's kind of hard. And look where price is bouncing. You still can use Fibonacci, and look, it's bouncing to 23% level right there. Look right here, 23, and so, like I said, the lower the volatility and the higher directional movement, the smaller the Fibonacci retracement levels you're looking at. But, you know, that's the thing though, that's the other problem, is like I was pointing out, look at this trend line. Where are you going to, look at this, look how much it varies, because there's not a lot of volatility. Look how long it is, you know, there's hardly any place for entry right here. So again, it's kind of hard to enter in a market like this. You want a market that has strong directional movement and medium to high volatility to use a successful trending method kind of tools that we've talked about. You know, there's some advanced things, EA systems that use like time zone and different tools like that help enter based on time, and then also mean reversion and stuff like that. You know, if we even inserted a, say, a moving average, the other thing that I showed you, I don't really use moving averages. I can kind of see the average with my eye, but a lot of people don't. So let's look at moving average. Let's just do simple. Let's do simple 50 period, okay? Now, this is how you see. What people are looking for is they're looking for the moving average to move down, but they're looking for price to go in the opposite direction for an entry. And the problem with doing moving averages is you got to get the periods right. So let's look at 15. Close. So you still don't kind of get any good buy signal, except for like right here, look. If you're using this moving average, you're looking for this. You're looking for price to go above the moving average. If you're thinking price will continue on this downtrend and then look to go down. So that's kind of a quickie on moving averages. We don't really have time to go into it. There's plenty of information on it out there though. But they're a good source for market analysis, especially in a trending market. But again, you got to look at trending as as both directional movement and volatility. If this had more volatility, you just think price should be going like this. Let's look at one that I haven't found one that has kind of a high directional movement and high amount of. So this is the daily chart on New Zealand and a high amount of volatility. Let's look at a 50 period moving average on this. So we're going to go to moving averages and we're going to do a 50. Let's try a 50 real quick. So this is what I'm talking about. But obviously it doesn't have as strong as directional movement, but it's strong enough. Look. Boom. This is what you're looking for. If it's an uptrend, you're looking for price to go below the moving average, and then you're looking to buy right here. It's called a rubber band trade. There's another word for it. So you're looking for a price to go all the way down and up. But the trend line's kind of it's so volatile that it's kind of hard. Let's look at a closer time. Let's try 4 hours. How about that? 1 hour. Oh, see here we have one. From there to there, right? And then we project it out. So, right here would be a good one. Because it exceeds the moving average, right? And it bounces off the trend line. So that's a decent setup for a trending market. Let's go back to... Look, that's have we not seen. So we haven't seen something that has kind of high volatility but low directional movement. You know, if you look at this section, it is pretty close. So this is pretty close. This is a consolidation period. So what are you looking for under these kind of situations? You're looking for SR levels, right? Support and resistance levels. So you're looking at levels like this and levels like this. So you're looking to buy at the red line down here and to sell at the red line up here. The problem is the price isn't doing that anymore, so that would have been a good idea. Look, price hit it like a bunch of times. But now price is going down sloping, so this is kind of a continuation pattern for a downtrend. So, because you're making lower lows or higher lows faster than you're making higher highs. See it? This angle is steeper than the top angle. So if this was the case in this ranging market, I would look to sell somewhere between the blue line and the red line and look for a continuation pattern. And this is a monthly, so this is like, let's look at where we lie. So what am I looking for now? So prices, again, this is an area where you have low DM and medium volatility. This area right here. So it's a ranging market, so I don't have pivot points or anything on here. I don't usually trade ranging markets. I'm a reversal pattern trader or a trending market follower. But let's say you're a range trader right here. You're looking for pivot points within this place. So what you do, you go down to 15-minute time frame. You plot your pivot points on here. And because we already looked at the monthly thing and that you have a ranging market monthly, but it looks like it might continue into a downtrend, I would look for sell at an SR level right there. And what else? I would look, see, this is tweezer tops with a hammer. I would look for another tweezer top right here and sell. But if you were, some people are really good at just trading the range. So you could buy right here and then put a, take profit order right here, a limit order. But given that we looked at a higher time frame, this goes back into using overlays, and I'm kind of hinting back into what we're going to be talking about later, and that's time. Given a higher time frame, I would say that it's ranging, but it's ranging towards breaking out to a trading market with a continuation in a dominant downward fashion. So I'd look to sell right here, given the dominance on it, if you're looking for, kind of a intraday trading. So let's see, that is, I think I've covered everything so far. It's kind of a brief overview, I apologize, but there's more information on this. You can find plenty of information out there that go into greater detail. This is just a brief series on different topics, but look for information, follow up on it. I think market environments are really important. I use them every day in my